Have you ever entered a trade and immediately regretted it as the price reversed against you? That's probably because you were looking at the market through only one lens. This image shows a classic example of multi-time frame analysis. On the left side, we see the daily chart, prices consolidating in a range and bouncing off a support zone marked in green. But now, look at the right side, zoomed into the 1-hour chart within the same range. What do we find? A clear double bottom reversal pattern forming right at that support. That's your buy signal. The higher time frame gives the location, the lower time frame gives the trigger. This is how smart traders trade, with clarity, not confusion. Now, take a look at this head and shoulders formation on the 4-hour chart. The left shoulder, head, and right shoulder are perfectly aligned, forming a sloping neckline. But if you only looked at this 4H chart, you'd wait forever for a clean entry. Zoom into the lower time frame on the right. This shows a breakout on the 15-minute chart. A surge of bullish momentum breaks the neckline resistance. This is not random. The higher time frame reveals the macro pattern, while the lower frame confirms the exact moment momentum shifts. When both time frames agree, your setup becomes powerful. In this image, we combine price action with the KST momentum indicator. It's split into different phases. First, a 27% rally over 63 days. The KST had already crossed above the zero line. This was a bullish confirmation. Then came a negative crossover, which warned of an upcoming drop. The price followed with a decline. Later, a second positive crossover signaled the next bullish run. Multi-time frame analysis isn't just about candles. It's also about how indicators behave across time frames. You don't just look for entry, look for aligned momentum across the board. This chart is a masterclass in technical alignment. We're looking at a weekly chart showing an ascending wedge. The price keeps bouncing between two diagonal trend lines, forming higher highs and higher lows. Overlaid are Fibonacci retracement levels from swing low to swing high. Price retraces to the 61.8% golden ratio, coinciding with the lower wedge support. This is powerful. The intersection of trendline and Fibonacci creates a potential reversal zone. You'd never catch this on a 5-minute chart. This is why smart traders zoom out first to build the context, then zoom in for entry. Here, we have a zoomed out versus zoomed in breakdown. On the left, a higher time frame chart shows a consolidation box, most likely on the 4H. The highlighted area is then zoomed into the 1-hour chart on the right. What do we find? Bearish divergence, a rejection from resistance, and a bearish engulfing candle. It shows internal market weakness within a bigger structure. This lets traders plan a short trade in the direction of the higher time frame trend with pinpoint entry. This is how you go from general market bias to laser-precise execution. This chart outlines a complete MTFA trading strategy: anticipate, participate, and avoid. In phase 1, the trend is bearish. Price forms lower lows and lower highs, so we anticipate a continuation. Once a lower high forms and price rejects resistance, we participate with a sell trade. The exit point is marked before price forms a higher low, sign of reversal. The avoid zone warns not to buy prematurely, even if the price bounces. By combining higher time frame trend with lower time frame confirmation, traders avoid emotional trades and act with precision. Now we have 4 charts working in harmony: monthly, weekly, daily, and hourly. Start from the monthly, a strong uptrend with impulsive candles. Weekly also shows continuation with small pullbacks. Daily chart breaks out of consolidation and resumes upward trend. Zooming into the hourly, we see a bullish flag forming, which breaks out in the direction of the trend. Each time frame confirms the next. When all charts point in the same direction, your setup becomes statistically stronger. That's called time frame alignment, and it's how institutional traders build positions. This image is the simplest yet most powerful way to understand MTFA. On the left, a higher time frame line chart shows a bullish trend with minor pullbacks. On the right, each pullback is zoomed into with candlesticks, revealing microstructures. Here's the secret. Each of those red pullbacks on the higher time frame is a short-term trend on the lower frame. If you trade pullbacks in the direction of the higher time frame, you stack probabilities in your favor. That's how professional scalpers trade with confidence, following the higher tide, entering on short dips. This chart shows a textbook bearish flag breakout. Price forms a descending wedge, tapping a resistance zone multiple times. A strong bearish candle breaks the structure. This is the entry trigger. Stop loss is marked above the wedge. Take profit below the next support. But here's the key. This trade only works if the 1H or 4H time frame shows a downtrend. When the breakout on the 5M aligns with the bigger picture, you get a powerful short setup. This is how MTFA allows for clean, low-risk trading, even on small time frames. Let's zoom out to the bigger picture. This is a daily chart showing a clean uptrend. Price continues to form higher highs and higher lows. A long-term moving average acts as support. The RSI confirms the trend by staying above 50. If we zoom into the 4H or 1H, we'll likely see bullish patterns forming at the moving average. This is your context. Before you enter any trade, always ask, what's the trend on the daily chart? That gives you the direction. The lower time frame gives you the entry. Here we have 4 time frames on one screen: 4H, 1H, 15M, and daily. Top left 4H chart shows price reacting to a purple supply zone with strong rejection wicks. Top right daily chart confirms bearish consolidation, hinting at upcoming breakdown. Bottom left 1H shows an ascending trend line with higher lows, suggesting short-term strength. But the bottom right 15M gives the real signal, a fake breakout followed by sharp rejection. This lower timeframe trap confirms the bearish move. When all 4 timeframes tell a story, you trade with confidence and structure. This last chart displays a UDCAD on 1H, 4H, and daily. All 3 timeframes align bullishly. The daily chart shows a strong uptrend with clean structure. The 4H chart shows price respecting dynamic support and printing bullish candles. The 1H chart provides the trigger, a breakout, retest, and strong bounce. Green check marks indicate ideal entry zones. Red X's warn of failure areas. This is full confluence. Every time frame agrees. This is what we mean by high probability trading. Entries backed by the full structure of the market. So what's the final takeaway from this multi-time frame analysis journey? It's simple. No single time frame tells the whole story. Professional traders use multi-time frame analysis to gain clarity, reduce noise, and make smart, calculated decisions. Use the higher time frame to set the direction, the mid-frame to locate key zones, and the lower frame to execute precise entries. This powerful method improves your accuracy, boosts your confidence, and helps you avoid emotional trading. At Financial Freedom FX, we believe that trading isn't about gambling. It's about having a process. If this video helped you, like and subscribe, and drop a comment telling us your favorite timeframes. Remember, we're here to help you grow, trade smart, and achieve real financial freedom.